All right, we're going to dive into a pretty explosive theory today about that insane crash we just saw in gold and silver. Our source material on this claims it wasn't just some random market correction. Nope, they say it was a planned, coordinated attack. So let's break down the evidence they're pointing to.
And they kick things off with this quote right here. This is not a correction anymore. This is a crash in progress. So right away, the message is clear. This wasn't some gentle, healthy pullback. This was a free fall. And according to the source, the sheer speed and violence of the collapse, well, that's your first clue that something is very, very wrong. So let's go to what our source calls the crime scene. As this whole thing was happening live, gold just smashed right through the huge psychological level of $4,500. And silver was in a nosedive to 72. This wasn't happening over weeks, it was a live cascading liquidation happening in real time. But this is where it gets really nuts. At the height of the panic, thousands of traders who were desperately trying to get out, to sell and stop the bleeding, they found that they couldn't. Orders were getting rejected out of nowhere. Trading platforms just froze up. They were literally trapped, forced to just sit there and watch as their accounts went up in smoke.
So that brings up the big question, right? What could possibly trigger a forced sell-off this widespread and this devastating? A market doesn't just spontaneously combust like this. The source argues that some external force had to have been applied, and they think they've found the weapon that was used.
And that weapon of choice, according to them, was margin hikes. Now, this isn't some super secret, complex financial instrument. It's actually a standard tool that exchanges use all the time. But the argument here is that it was used like a sledgehammer with unprecedented force and timing.
So how does this work? It's pretty simple, actually. Imagine you put down a 10% deposit to control a very large position in silver futures. If the exchange suddenly turns around and says, hey, we now require 15%, you have to come up with that extra 5% in cash, like immediately. And if you can't, too bad. They automatically sell your position at whatever the current market price is. And in a crash, well, that's the absolute worst price possible. It's a brutal but brutally effective way to force people out of their positions. And this timeline here, it really lays out the alleged strategy. This wasn't just one hike, it was a constant barrage. 8 hikes in 8 weeks. And just look at the timing. On Christmas Day, over New Year's weekend, these are times when traders are away from their desks and the markets are thin, which just maximizes the pain. And the final blow, what the source calls the kill shot, was switching to percentage-based margins that basically created a trap that tightened on its own as the price fell. Now, to put this into perspective, just look at this chart. In a normal year, you might see 2, maybe 3 margin hikes for silver. Their data shows 8 of them in just the last 8 weeks. That's not just business as usual, folks. That is a huge statistical outlier. And to the source, an outlier that big suggests one thing: a clear intent to drain cash out of the system and force people to sell. All right, so the next piece of this puzzle, according to our source, involves 2 incredibly powerful institutions who are normally fierce competitors, suddenly and strangely acting in perfect lockstep. So on one hand, you have the CME in Chicago, and on the other, you have the SGE in Shanghai. I mean, these guys compete for every scrap of business. Their home countries are geopolitical rivals. They almost never agree on anything. And yet, the source points out that on the very same day, they both raised silver margins. The odds of that just being a coincidence are pretty slim, to say the least. So that's the billion-dollar question, isn't it? What possible common threat could be so big that it would unite these 2 powerful rival exchanges? Well, the source believes the answer is buried in a fundamental weakness, a fatal flaw, at the very heart of the physical silver market. And it all comes down to this number: 356 to 1. According to the source's data from the COMEX exchange, for every single ounce of physical silver they actually have sitting in their vaults, there are 356 different paper claims to that exact same ounce. It's a massive system of paper promises, and it works just fine, as long as everybody is happy to trade the paper and never asks for the real thing. But what happens when people do start asking for the real thing? Well, that takes us to the March delivery month. You had futures contracts promising the delivery of 528 million ounces of silver. The problem? As you can see here, the COMEX vaults only held 113 million ounces. They had sold paper promises on nearly 5 times more silver than they actually had. And that leads to the absolute nightmare scenario for the exchange. All it would take is for just 22% of those people holding contracts to say, you know what, I don't want the cash, give me the physical metal. If that happened, the vaults would be wiped clean, empty. This, the source claims, is the existential threat that brought Chicago and Shanghai together, the terrifying risk of a full-blown bank run on physical silver. Okay, and now we get to the piece of evidence that the source calls the smoking gun, a massive, real-time split in the market that they argue is absolute proof that this whole crash was manufactured. So get this. On the same day, at the exact same moment in time, a single commodity, silver, had two totally different prices on planet Earth. In New York, the paper futures price was crashing down through $72, but in Shanghai, where they trade actual physical metal, the price was holding strong at $100. That's a $28 gap per ounce. In any healthy functioning market, arbitrage traders would close a gap like that in a matter of seconds. The fact that it existed at all and that it stayed there is what our source points to as undeniable proof of a broken market. One price was reflecting a panic in paper promises, while the other was reflecting the hard reality of physical scarcity. And this quote from the source really just sums up their whole argument. They argue that the big, sophisticated buyers in Shanghai would never pay a nearly 40% premium unless they knew that the lower paper price was completely artificial and temporary. The physical market was screaming that the real value was way, way higher than the liquidation price on the paper market. So with this whole crazy situation laid out, the source doesn't just leave it there. They also provide a sort of dashboard of key things to watch so you can track how this story unfolds for yourself in real time. And here are those warning lights. First, the Shanghai premium. If that gap gets wider, it's a huge sign the paper price is losing all credibility. Next, COMEX vault levels. Is physical metal still getting drained out of the system at a fast pace? Then you have lease rates. That's basically the interest rate for borrowing physical silver. If those spike, it means big players are desperate to get their hands on actual metal. Keep an eye on the open interest for March delivery. If that stays high, the pressure is still on. And finally, just general system stress. Watch for more trading halts or frozen platforms. Those are signs the whole system is creaking under the strain. And this is the final thought from our source material, and it's a powerful one. Throughout history, the price of a paper promise and the price of a physical thing can drift apart, but they never stay apart forever. A reconnection is always inevitable. The only real question is whether it's going to be an orderly handshake or a violent collision, and just how much damage gets done before it happens.